Brad Williams, Frugal Finance. Let's talk about high deductible medical insurance plans. We are in an environment where we're stuck with these overbearing, horribly designed health insurance programs. Many are provided by the employer. Subsequently, you're given a benefit. The bottom line here is health insurance, the cost of being admitted to a hospital is going to cost you, I could say, an arm and a leg without a pun intended, but it's not a pretty situation. So here is a tool that you can implement to maybe offset perhaps some of the costs related to medical care, and that is a health savings account. They are investment accounts that allow you to set aside pre-tax dollars for qualified medical expenses to pay for outlays not covered by your health insurance plan. By setting aside money pre-tax, your contributions don't count towards your adjustable gross income at the end of the year. Yeah, there's a bit of a benefit, but there's some advantages and disadvantages here. I'm just going to use HSA. To take advantage of an HSA, you need to understand how they work and the rules that apply. To open an HSA, you need to be covered by a high deductible health plan. You'll know when you see your deductible is $6,000 before any coverage, before the insurance company starts paying any of your costs. An HSA is a type of tax-advantaged medical savings account with features that could help you save for medical expenses and give you the option to invest those funds. However, in order to qualify for an HSA, you must participate in a HDHP, high deductible health plan. In these accounts, you pay more of your medical expenses out of pocket with insurance coverage applying only after you reach a certain deductible. Now, if you're not up to date on how threatening these high deductible health plans are, you need to read the coverage. They are very, very complex, and they shouldn't be. For example, let's say you have a $6,000 deductible, you have a 20% copay with a max out-of-pocket 10 grand. That's a lot of money. So, for example, you step in, you have a medical procedure. It's $15,000. Well, $6,000 is going to come out of your pocket. Then you take 15 minus 6. You take 20% of that. That's going to be 9,000 times 0.2 is, let's just round it up to, let's say that's $1,500. Then your kid is admitted, they broke their arm. The costs eventually climb up to 10 grand to you. In other words, your maximum is 10 grand. But here's the caveat. Your child may not fit under that umbrella. So you have to start over. And this just horribly designed system is going to force you to continue paying these medical costs, even though you quote unquote have health insurance. So be very, very, very careful about these high deductible health plans. And it's one of those pay now or pay later kind of deal. In other words, perhaps you improve your health plan and try to remove this high deductible. I know sometimes it's tough because the cash coming out of your check, you make a lot of money, but next thing you know, very little is trickling down to into your pocket because it's going to different type of benefits that you've chosen. If your employer doesn't have an HSA, you may be able to open one on your own. This is for those self-employed or the contractors or the individuals who want to be independent. Well, you can set up an HSA on your own. HSA are investment accounts. In other words, that 10 grand that I used as an example, if you have an HSA, you can pull that money out without penalty to cover some of those costs. HSAs are investment accounts. In many ways, HSAs are similar to 401ks. If you set up an HSA at work, your money is deducted from your paycheck pre-tax, and you can generally choose among investments, such as stocks and mutual funds in which to invest the funds. Your employer might make contributions to your health savings account as well. If you set up an HSA on your own, your choices can vary by financial institution. Either way, HSAs usually provide the option to keep some or all of your contributions in cash. Withdrawals from an HSA are never taxed as long as the money is used for qualified medical expenses. The money in an HSA belongs to you whether you set it up for future medical expenses or not. However, If you don't put withdrawals towards medical expenses, you'll be subject to income tax on that money. In addition, you'll be subject to a 20% penalty on HSA distributions used for non-medical expenses unless you reach the age of 65 or become disabled. Funds in your HSA don't need to be withdrawn at the end of the plan year. Keep that in mind. You have these flexible spending accounts, and then you have HSAs. They're two different beasts. Funds in your HSA don't need to be withdrawn at the end of a plan year. Your dollars can be rolled over year after year, meaning there's no use it or lose it constraint. By letting these funds accumulate, they can be saved for large medical expenses, and there's no required minimum distribution. In addition, HSA is portable. You can take account with you if you switch jobs. And then regarding flexible spending accounts are employer-sponsored accounts that let you set aside pre-tax dollars for eligible healthcare costs. However, while you control the funds in the HSA, the money in your FSA is held by your employer, and any funds not used by the end of the year are generally forfeited. Before establishing an HSA or making contributions, you might want to seek advice from a tax professional, investment professional, or the HR department. Let me know what you think about these particular programs, whether you find them beneficial, whether you've used them, whether it's worth the effort, if you've had success. Share your thoughts. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.